A major change happened in the tax code today. For senior citizens and retirees, this particular under-the-radar adjustment has the ability to decide whether thousands of your dollars stay in your pocket or get sent to the IRS before you even realize it. This isn't something you'll probably see featured on the nightly news. Most tax experts won't bring up the information unless you directly ask. And by the time a huge number of retirees find out about it, those funds will have already been handed over. This isn't speculation, this isn't rumor. This is a recently enacted IRS filing rule that has just taken effect, and it has a direct influence on American citizens aged 65 and above. If your earnings come from Social Security, retirement accounts, a company pension, or even a modest amount of employment income, the details that follow are more important than virtually any tax rule you've come across in recent memory. This adjustment isn't small, it isn't just ceremonial, and it isn't here forever. In fact, it has a firm deadline attached to it, and when that window closes, the opportunity to capitalize is over. The reason this demands your immediate focus is simple. If you don't understand this new rule now, you cannot develop a plan to utilize it. You cannot protect your money against overpayment, and you could find yourself giving the federal government money it is no longer authorized to take from you. By the end of this presentation, you will have a thorough understanding of what changed, who qualifies, and why waiting around or assuming an expert will handle it could end up costing you considerably more than you expect. Here's the part that almost no one is discussing. Well, a new IRS provision has now been officially implemented, allowing citizens 65 and above to claim an additional tax deduction on their annual return, in addition to all the advantages they already receive. For a qualifying individual, this deduction totals $6,000. For a married couple where both partners qualify, it reaches $12,000. This isn't a tax credit. It's not a temporary tweak buried in the fine print. This is a direct reduction from your overall taxable income. Real dollars that are now protected from federal income tax. Unlike many tax adjustments that benefit only a narrow group or require complicated financial maneuvers, this one is widely accessible to seniors whose income falls within certain defined limits. What makes this particularly significant is that this deduction is layered on top of the standard deduction and the existing supplemental deduction for older taxpayers that seniors have always been entitled to. In simple terms, this means a considerable portion of retirement income can now be shielded from federal taxation, provided you qualify and you submit it correctly. However, this is where the urgency factor comes into play. This deduction is not permanent. It is applicable only for a restricted 4-year period from 2025 through 2028. After that time, assuming Congress does not act to extend it, it disappears entirely. No allowances for prior years, no option to request it retroactively, and no additional chances. This means every monetary decision you make regarding income, investment distributions, and the timing of these moves during this 4-year period has greater significance than ever before. This isn't something you can delay learning about until another time, and there exists a requirement, not a hidden trap, but a condition that many people misunderstand. This deduction starts to diminish once your yearly income goes beyond specific limits. For individuals filing solo, the reduction kicks in at $75,000. For married couples filing jointly, it starts at $150,000. Once your earnings exceed these amounts, the advantage shrinks and eventually disappears altogether. This makes thoughtful preparation necessary, accurate timing critical, and wrong assumptions potentially costly. What is especially important to recognize is that this deduction was not created to benefit elaborate tax evasion schemes or sophisticated financial tactics. It was developed to provide real support to seniors facing rising expenses, inflation, elevated healthcare costs, and reduced purchasing power during their retirement years. However, the IRS is not going to automatically grant this benefit just because you're old enough to be eligible. If you're unaware it exists, if you don't submit it properly, or if you structure your income without comprehending how this provision operates, the benefit does not apply to you. This is the reason a large number of retired Americans are at risk of missing it, not through any mistake of their own, but because no one has plainly described the recent change and why it demands prompt attention. Before we proceed, allow Michel to briefly introduce himself so you know why he is walking you through this content and why the details matter. Hello, my name is Michel, and my focus involves converting complex financial and governmental regulations into clear, easy-to-digest language, with particular attention to the kinds of provisions that quietly affect retirees and older adults the most. There is no hype, no scare tactics, no oversimplification, just straightforward explanation so you can make educated decisions and prevent expensive mistakes. With that covered, let's get back to explaining why this new deduction is so unlike any other tax provision you have seen before. For many years, seniors have become familiar with a single basic structure regarding their taxes. Your choices are to take the standard deduction or to itemize your qualifying expenses. If you've reached age 65 or beyond, you're used to receiving a small additional amount included with your standard deduction. That has been a consistent element of the tax code for a long time. Many retirees assume this is the whole story. However, this newly created senior bonus deduction completely transforms that entire framework. And this is exactly where people start to undervalue its importance. This $6,000 deduction operates completely separately from your standard deduction. It does not replace it. It doesn't force you to select one advantage over another. It is stacked on top of all the deductions you presently receive. This combined result is what transforms this from a small tax benefit to a provision that can truly reshape your tax burden. What makes this especially notable is that your filing approach, whether you itemize or not, doesn't matter. Usually, tax deductions force you to choose one direction. If you itemize healthcare expenses, charitable contributions, or mortgage interest, you lose the standard deduction. If you select the standard deduction, you cannot claim most itemized expenses. This new senior bonus is unaffected by which method you choose. Whether you itemize every qualified expense or you take the standard deduction without documenting a single receipt, this deduction still applies. That feature alone makes it one of the most flexible tax benefits for older Americans introduced in many years. There's no complicated decision-making involved, no penalty for selecting one approach over the other. If you satisfy the requirements based on your age and annual income, the deduction is yours to use. To truly understand why this is so significant, you need to look at actual numbers, not general percentages. Imagine you're a single taxpayer age 65 or beyond. For the 2025 tax year, the standard deduction alone shields $15,950 of your income from federal income tax. Because of your age, you also qualify for the long-standing age-based supplement, which adds another $2,000. That portion is not a recent development. What is a recent development is that provided your overall income stays below the threshold where the benefit begins to shrink, you now add an additional $6,000 on top of that amount. When you combine these three elements, you're considering nearly $23,750 of income that is never even included in the federal tax computation. This is not a legal loophole. It's not an aggressive tax approach. It is simply the current law. Now think about what this means in real-world terms. A significant number of retired people survive on a combination of Social Security payments and modest withdrawals from their retirement accounts. If approximately $24,000 of that annual income is protected before taxes are even computed, the impact can be considerable. It could be the determining factor between owing taxes and owing nothing. It could mean the difference between depleting more of your savings and preserving the wealth you built over decades of employment. This is exactly why not understanding this deduction proves so harmful. Retirees often assume their tax situations are fixed and unchangeable, when in reality a single provision like this can entirely alter the final result of their yearly return. And this addresses only the scenario for a single person. The numbers become even more striking when you consider married couples, particularly those trying to stretch their retirement savings for 20 or 30 years. However, before we look at that, there's a vital point you need to understand, because this is where many people make their first major mistake. They hear about a new deduction like this and assume it's applied automatically, that the IRS will simply add it without any effort on their side. This assumption alone is causing retirees to lose significant amounts of money. In the following portion, Michelle will explain exactly why that belief is wrong and what actions you must take to ensure this benefit doesn't slip past you unnoticed. One of the most expensive misunderstandings seniors have concerning taxes is the assumption that new deductions are applied automatically. The notion that the IRS somehow identifies your eligibility and silently adds the benefit for you. That is not how the process works. The IRS does not proactively look for ways to decrease the taxes you owe. It simply processes the data you provide. If this deduction is not properly claimed on your tax documents, It essentially does not exist from the IRS's perspective. And this is the point where a surprising number of retired people end up losing funds. Not because the provision itself is complicated, but because they don't realize an additional step is required. The good news is that claiming this deduction isn't difficult. However, you do need to be intentional about it. You must file your taxes using either Form 1040 or the Form 1040 SR created for seniors, and you must correctly indicate that you are 65 years of age or beyond. That simple checkbox activates the calculation process that allows this deduction to be utilized. Miss it, rush past it, or rely on outdated assumptions, and the benefit never takes effect. This issue is magnified because this deduction isn't something the majority of seniors have seen before. For many years, the tax system trained retirees to think in a very narrow way. Standard deduction, possibly a modest boost for age, and that's the whole picture. As a result, when a new provision appears, many people don't even think to look for it. They assume nothing important has changed. But something has changed, and it's significant. And unlike refundable tax credits, which often are introduced gradually or require specific eligibility, this deduction directly reduces your income subject to taxation line by line. This makes accuracy essential. If you're using tax preparation software, the calculations are handled for you, but only if the accurate information is entered. If you're working with a tax professional, you need to confirm they are aware of this new provision and aren't simply applying the prior year's approach. This deduction is a recent addition, and new provisions are exactly where mistakes occur most frequently. Now let's discuss the income limits because this is where confusion really develops. The senior bonus deduction doesn't disappear suddenly. Instead, it is phased out gradually once your income exceeds certain amounts. For individuals filing alone, this phase-out begins at $75,000. For married couples filing together, it starts at $150,000. Above those figures, the deduction is decreased by $60 for each $1,000 of income above the limit. This might appear minor at first, but it adds up over time. Eventually, if income reaches $175,000 for an individual or $250,000 for a married couple, the deduction is removed completely. No partial amount, no alternative. It simply stops applying. This structure is intentional. The deduction was designed at helping lower and middle income seniors who are more vulnerable to inflation, increasing healthcare expenses, and diminished purchasing power. From a policy standpoint, that is reasonable. But from a financial planning standpoint, it means you need to be completely aware of your precise income level. Even if your earnings place you within the phase-out zone, every dollar of deduction you can still claim is meaningful. Partial deductions still represent real savings, and those savings compound when you consider that this provision applies for up to 4 consecutive tax years. Ignoring a partial benefit because it's not the full amount stands as one of the most common and expensive mistakes retirees make. There's another factor here that people frequently overlook. Your modified adjusted gross income doesn't only consist of wages. It includes distributions from retirement accounts, profits from taxable investments, income from a business, earnings from rental properties, and numerous other sources. This means decisions about when and how you receive income now carry tax consequences that didn't exist before. Taking a somewhat larger withdrawal from an IRA in 1 year could reduce your deduction more than you expected. Spreading your income differently across multiple years could preserve thousands of dollars in deductions during this 4-year window. This is where strategic timing becomes crucial. And this is the reason understanding the phase-out regulations now before you file your taxes holds such importance. But before we explore planning in more depth, there's a widespread myth circulating online that needs immediate correction. Because misunderstanding this point leads people to form seriously incorrect conclusions about taxes on Social Security payments. In the following section, Michelle will clarify exactly what this deduction does and what it does not do concerning Social Security, so you aren't tricked into believing something that is simply wrong. There is a belief spreading rapidly across the internet that this new deduction completely eliminates taxes on Social Security payments. That belief is incorrect, and relying on it could cause people to make extremely damaging financial decisions. This new senior bonus deduction does not by itself make Social Security benefits tax-free. The rules governing the taxation of Social Security have not been altered. What has been altered is the portion of your overall income that becomes subject to those existing rules under the current regulations. Social Security benefits become subject to taxation once your combined income exceeds certain thresholds. For individuals filing taxes alone, that threshold starts at $25,000. For married couples filing a joint return, it begins at $32,000. Combined income is calculated as your adjusted gross income plus 1/2 of your Social Security benefits. If your earnings exceed these amounts, as much as 85% of your Social Security payments may be subject to federal income tax. That framework remains entirely unchanged. What this new deduction accomplishes is a reduction of your taxable income following those computations, which can considerably lower or even eliminate entirely the actual tax you ultimately owe. Here's an example of this in a real-world scenario. Imagine a single retiree receiving the average Social Security benefit, approximately $24,000 annually. Under the standard rules, a substantial portion of that benefit might be deemed taxable. However, when you include the standard deduction, the existing age-based supplemental deduction, and this new $6,000 senior bonus, the total amount of income shielded from taxation can actually surpass the taxable portion of the Social Security income. In this scenario, the result is minimal or zero federal income tax liability. This isn't because Social Security was somehow made tax-exempt, but because the available deductions eliminated the taxable income before any tax obligation developed. This distinction is important because if you incorrectly believe Social Security taxes have been eliminated entirely, you might wrongly assess how additional income will affect your situation. This consideration becomes even more critical when Social Security isn't your sole income source. Many retirees have multiple streams of revenue. Perhaps you're taking distributions from an IRA or a 401k. Maybe you receive dividend payments from stocks or other investments. Perhaps you continue to work on a part-time basis or receive earnings from a property you lease out. All of these sources count toward your income, and all contribute to your modified adjusted gross income. This figure determines both the portion of your Social Security that is subject to tax and the amount of this new deduction you're allowed to keep. To demonstrate the potential impact, examine a single senior receiving $40,000 in Social Security benefits, along with an additional $40,000 from retirement account withdrawals. Under the previous tax rules, this scenario might result in a federal tax obligation exceeding $7,000. With the new senior bonus deduction applied correctly, that tax bill is reduced by more than $1,500. This is not a theoretical estimate. It is a direct result of how this deduction interacts with established tax law. For married couples in similar financial situations, the amount saved can be even larger. And when you multiply those annual savings across 4 separate tax years, the cumulative impact becomes quite substantial. This is exactly why the timing of income matters so greatly. When you have some control over your income, such as with withdrawals from retirement accounts, you suddenly gain the power to influence how much of this deduction you manage to retain. In certain situations, shifting some income into these 4 specific years might be beneficial. In other cases, delaying certain income until after the deduction period concludes could be the smarter move. There is no universal answer that fits everyone, but there is one principle that applies to all. Failing to consider the relationship between your various income sources and this deduction is a mistake. Another essential point that often receives inadequate attention is that this deduction applies regardless of whether you are fully retired or still actively working. Being 65 years or older is the only requirement, not your retirement status. If you are 67 and still earning wages even from a part-time position, this deduction can still be claimed, provided your total income remains within the phase-out limits. This is particularly relevant for individuals in the process of transitioning into retirement. Perhaps you've reduced your working hours but haven't completely stopped. Maybe you've delayed claiming Social Security but are still receiving a paycheck. This deduction can provide meaningful financial relief during those transitional years when income can be unpredictable and financial planning is most difficult. This brings us to a common worry for many people. They fear that claiming a newly available deduction might increase their audit risk or attract unnecessary attention from tax authorities. This concern is understandable, but it is largely unfounded. This deduction is explicitly permitted by federal law. It is calculated using standard government tax forms, and when it is claimed correctly and accurately, it does not trigger scrutiny any more than claiming the regular standard deduction would. The behaviors that genuinely increase risk are filing your taxes incorrectly, skipping necessary steps, or relying on baseless assumptions rather than accurate, verified information. In the next portion, Michelle will explain step by step exactly how this deduction is officially recorded on your tax return, which specific forms are involved, and why the entire process is considerably simpler than most people expect. Now let's examine how this provision actually appears on your tax documents, because this is where nervousness often builds for many individuals. The concept of a new regulation can make it seem complicated, but in truth, claiming this deduction is much more straightforward than most seniors anticipate. When you prepare and file your 2025 tax return in early 2026, you will use either the standard Form 1040 or the Form 1040-SR designed specifically for senior taxpayers. The majority of people over 65 prefer Form 1040-SR as it features larger print, a cleaner layout, and instructions that are easier to follow. While completing the form, you will check a box indicating your age is 65 or above. This simple action signals the IRS processing system to apply the age-related provisions that follow. From this point, the calculation for the senior bonus deduction proceeds through a designated worksheet created specifically for these additional deductions. In practical terms, you are not inventing anything new, making guesses, or providing explanations. You are simply following a predetermined set of instructions. A recently introduced schedule is used to calculate this deduction, and it guides you through the process in a structured manner. First, it determines your modified adjusted gross income. Next, it applies the phase-out reductions if your income exceeds the specified threshold. Finally, the qualifying portion of the deduction is transferred to your main tax form, where it immediately reduces your taxable income. If you use reliable tax preparation software, this process occurs almost entirely automatically, provided you have entered the correct information. If you hire a tax professional, the procedure is equally simple, assuming they are informed about the new provision and implement it properly. This demonstrates why simply being aware is so important. The deduction doesn't require specialized expertise, but it does require careful attention. If you overlook it, no warning is generated. The IRS will not send you a notification asking whether you meant to claim it. If the deduction is missing from your filing, the system simply assumes you were ineligible or chose not to utilize it. What is reassuring is that this deduction does not require any change to your lifestyle or your financial management habits. There is no need to spend money in a particular way, no requirement for a special account, and no additional documentation beyond what you normally provide. It is an official recognition embedded in law that seniors experience different financial realities compared to younger wage earners. This brings us to the core reason this deduction was created. Over the past years, inflation has steadily eroded the purchasing power of retired people. Healthcare costs have continued their upward climb. Prescription medication remains expensive. Property taxes, insurance premiums, and basic living necessities have all increased. At the same time, many older adults rely on fixed or relatively fixed incomes that do not adjust quickly to economic pressures. This deduction is not a handout. It is a corrective measure, one that acknowledges these difficulties and offers targeted assistance where it is most needed. To understand the practical impact, consider it in terms of tax brackets. A $6,000 deduction does more than just reduce your income on paper. It produces real tax savings. For a taxpayer in the 22% federal income tax bracket, this deduction saves approximately $1,300 in taxes. That represents $1,300 that can be directed to medication, medical co-payments, home repairs, or simply creating some additional breathing room in a monthly budget. For married couples, the $12,000 deduction can potentially double that financial advantage. This is why this deduction feels different. It is not an abstract idea. Its effect is experienced as money that stays in your hands instead of being paid out. It's also helpful to view this deduction within the context of broader adjustments introduced by the same legislative package. There were additional provisions targeted at working people, such as deductions connected to overtime pay, tips, and certain vehicle-related expenses. However, this senior bonus deduction sets itself apart because of its flexibility and size. It does not confine you to a narrow category. It does not require itemizing your expenses. It does not depend on specific spending patterns. It simply applies based on your age and income level. This characteristic makes it accessible to countless retirees who might otherwise be unable to benefit from relief programs that are overly complex or have rigid requirements. The mistake many people make is treating this like just another minor tax adjustment, something to briefly consider once a year and then forget. But because this deduction is available for a limited 4-year time frame, It deserves greater consideration than that. Every year you fail to claim it, or every year you arrange your income without accounting for it, represents a year of missed opportunity. And once this window closes, there is no mechanism to go back and recover what you failed to use. In the final portion of this presentation, Michelle wants to address the importance of timing, planning ahead, and ways to protect yourself, not only from overpaying your taxes, but also from scams, false information, and the last-minute pressure that leads people to make poor choices when tax filing season arrives. One of the most significant mistakes retirees make regarding taxes isn't failing to understand the rules. It's postponing consideration of them until it's too late. The tax filing period has a tendency to arrive unexpectedly.